Williams,
Here.
Tim Hodges. No Tim Hodges. Okay, Kathy McKinnon,
Here.
George Perez. Oh, no George yet. Okay, I know that Franklin Perry will not be in attendance today. He did reach out to me. Sarah Sanders.
Here.
And Gwendolyn Thames. Okay, so we're missing a few people. Do we want to wait?
Tim Hodges is on.
Oh,
Okay,
okay.
Miss Hunt, okay.
Okay, so we have Tim, Jerry, and Kathy, and Sarah. So we do have quorum.
I suggest we just get going. We have a series of reports today, no action items. Of course, we have the important 2020 audit results, but the first item is Hazim, financial statements.
Sure. Good morning, everybody. This morning, I'm just going to touch a bit regarding the 2020 audited financial statements, and then I'm going to hand it off to Ron and Jessica, who are from Clifton Larson Allen, and they are going to provide the 2020 audit results. So for the 2020 audited financial, in terms of the summary, we did make 1,636 single-family mortgages totaling 302 million, compared to 2,877 mortgages totaling 525 million in 2019. So we did discuss this previously that for 2020, we did see a reduction close to 50% when it comes to our single-family program. For multifamily, we closed about 107 million compared to 112. So in terms of multifamily, it's about the same. In terms of the series of bonds, we sold one less bond in 2020 compared to 2019. However, the size of the sale is about the same. The difference is in 2020, because we are not seeing that much production. However, interest rate was low. We were focusing a lot on reducing our interest expense. So we were doing a lot of refunding. So you can see this report or this being reflected when Allison presents her report. In terms of bond payables is about the same. Like I said, we were focusing on refunding. In terms of other obligation, we did record 70.5 million for our net pension liability and 82.4 million for our other post-employment benefits. For 2020, the pension liability did go down by about 5 million or 6 million, I should say. But then the OPEB did increase by about 4 million. Overall, operating income was about 19.3 million. Having said that, and I would like to hand it off to Ron and Jessica from Clifton Larson Allen to talk about the 2020 audit result.
All right. Thank you very much, Azim. That was one of the fastest times I found my mute button in the last year. So as we have in the past, I'll go through relatively quickly the audit results, which really are the important facets, if you will, relative to what we have to report to you today. And we'll also go through some, quickly we'll go through some required communications that come from us, the auditors, to you, those charged with governance. We did talk about, back in the planning meeting, we did talk about the fact that we had changed names, if you will. Bloom Shapiro was acquired by Clifton Larson Allen. And so the engagement team was pretty much the same. Actually, I think, quite honestly, exactly the same as it was over the past couple of years, other than the one change that was inserted into the process is that financial statements now go through, and the audit binder itself, so all of our work product goes through a national QC reviewer as opposed to at Bloom, the policy was we utilized concurrent reviewers. So it was at Bloom another engagement partner. So some client service partner with expertise in government and in quasi-government entities was reviewing our work in the financial statements in prior years. CLA utilizes, as a national firm, as expected, utilizes a centralized quality control function. So the folks that are reviewing this information, the financial statements and our work papers, that's what they do full time. And there is a group that deals only with governmental entities. And in fact, there's a small group because they kind of sit in smaller silos relative to expertise. There's a group that deals with housing finance agencies, which CLA has quite a few on their roster. So it was hopefully seamless to Hazim and Allison and their team. It was a little different for us. There were a few things that popped out that caught Jess and I by surprise, but nothing that was onerous in the way of having to deal with it or modify some work or something to that degree. So we did get through it pretty cleanly, quite honestly. And I think that's a testament to Bloom's audit process, as well as a testament to the CHFA and Hazim and Allison and their team as well. So having said that, the reporting results for the year, as Hazim has up on the screen, I'm assuming Hazim is running this, maybe not, but that's our audit opinion that is in front of you on the screen right now. And that's an unmodified or clean audit opinion on the financial statements, which basically is saying that in our opinion, the financial statements fairly represent financial position and results of operations of CHFA for the year ended December 31st, 2020. As I have explained in the past, we're also required to report to you under some other standards, governmental auditing standards, uniform guidance, which is formerly federal single audit, and then also the state of Connecticut Single Audit Act. So under uniform guidance, we would be reporting to you any significant deficiencies or material weaknesses in internal control relative to the financial reporting process, so relative to these financial statements. And then we would also need to report to you any violations of compliance that were detected while we were performing our procedures of the audit that in our opinion could be material to the financial statement. So in that report, we refer to it as the Yellow Book report or the GAO report. And it's contained in your single audit packages. So the federal single audit and the state single audit both have that report. There were no findings relative to that report. So there were no significant deficiencies or material weaknesses in internal controls, and there were no violations of compliance that were detected during the performance of our procedures.
Hey, Ron, sorry to interrupt. Lorraine, can you go down to the next packet, like just page 91. Yep.
There we go. Okay.
Yeah, just go down.
So I'm on slide 5 now.
Okay.
For whoever's running that deck, and I'll keep you
3,
posted.
4, 5. The next one.
Okay. Yeah. So
Yep.
under uniform guidance, up one if you would. I apologize. Okay. Under uniform guidance, it's similar to that Yellow Book report, the governmental auditing standards, in that we're required to report to you any significant deficiencies or material weaknesses in internal control and any violations of compliance. And we also issue an opinion on compliance, but all of that is relative purely to the federal program or programs that we are testing, the major federal programs. It isn't entity-wide, which is what the Yellow Book report is referencing. So relative to that, the only program that met major program status that we had to test under uniform guidance was the Section 8 project-based cluster. We issued an unmodified or clean audit opinion on compliance relative to that program. And then in relation to internal controls, again, there were no findings relative to internal controls. So no significant deficiencies or material weaknesses relative to that program that we tested. Next slide is a similar summary relative to the state single audit. State Single Audit Act mirrors the Federal Single Audit Act, so we're doing the same thing, only it is over state major programs as opposed to federal major programs. As you see with the next to the diamonds there there were actually 3 programs that met major program status under the state single audit that we tested: the state portfolio preservation, pre-development and critical needs, and ending chronic homelessness. And again, we issued an unmodified opinion relative to compliance over those, all 3 of those programs. And relative to internal control findings, there were no significant deficiencies or material weaknesses over the controls relative to those compliance requirements in any of the 3 programs. So, pretty much, not pretty much, same results all the way through. So Yellow Book, Federal Single Audit, State Single Audit, we were very clean relative to the reporting and relative to the administration of those programs. The next few slides, and I'm not going to go through them. You can read them at your leisure, and certainly we're here on the other end of the line, probably most efficient if any questions that you may have relative to the audit area and the the procedures we performed, and clearly they're in summary format, if you will, and the results of those, the performance of those procedures. If you have any questions, best if they're channeled through Hazim or Allison, through to us. But if you want to reach out to us directly, certainly you can feel free to do that. But in all cases, as you plow through these, there were no significant findings or anything that caused us any concern relative to what we were uncovering in the performance of our procedures. So I'm going to jump you all the way up to, it's going to be slide 11, which we'll go through briefly, and I'll be done with the required communications. So these are the required communications that are established by the AICPA under SAS 114 that we are required to communicate to you, those charged with governance. And the basis of these, although they're, the categories, if you will, are all seemingly different and eclectic, they're really not. What they're trying to vet out is, were there any areas that management was displaying bias relative to the financial statement? So was management trying to make things look better than they actually were, or were they trying to make things worse than they actually were? And probably the most significant area that could occur is under this first category, qualitative aspects of accounting practices, and it really relates to the estimates that are embedded in financial statements. And in any financial statement you'll ever pick up and read, these are not hard numbers, so to speak. An allowance for receivables, your net pension liabilities and actuarial estimate, OPEB liability is an actuarial estimate, and the fair value of the swaps are estimates that are fair valued by a third party. So these are the significant estimates that, in our opinion, are embedded in the financial statements of CHFA. We evaluate all of those estimates to determine if there is any bias. We evaluate them for reasonableness. So there's a comparative analysis that goes on that stretches back now for us, stretching back, I think, 4 years we had to look back to at this point in time. So in the end, the results of this is that, in our opinion, the significant estimates were evaluated and found to be neutral and reasonable. So there was no indication of bias. And the rest of these, I won't take time going through them, other than if you see on the bottom of the screen, the uncorrected misstatements, and then if you would jump to the next screen, the corrected misstatements. In both cases, it's the same response. Management didn't identify and we did not notify them. So we didn't find anything relative to the performance of our procedures that caused us to present management with a proposed audit adjustment, and vice versa. Sometimes during an engagement, management itself will, because they're still preparing some of the portions of the financial statements, they may find that there's an adjustment that needs to be posted. subsequent to closing the books, and that did not occur either. And that's another area that's, all of these, again, are designed to present, the thought of bias, if you will, if there were something we would need to report to you. But the estimates and the corrected misstatements and uncorrected misstatements are the most significant. So, in these cases relative to bias, what we'd be talking about is, I often give this example. If we proposed 10 audit adjustments to management based on what we found when we were performing our procedures, and 5 of them were making things look better and 5 of them were making things look worse, and management chose only to post the ones that made things look better, that would be clearly an indication of bias, and we would be reporting that to you. But in all cases, all of the required communication areas that SAS 114 requires us to speak to you about, there were no issues that came out that caused us any concern. So that will end. I think if you go to the last slide, I kind of forget if we don't. I thought I had our contact information, but again, you can reach us through Allison or Hazim if you need to reach out to us directly. If you have any questions today for me, I'd be more than happy to address them.
Ron, I was just wondering, this seems to be extremely clean, no problems at all from what I'm hearing. Is that correct?
Yeah, yes, that's a correct assessment. We're not encountering any issues relative to the financial statements, to the reasonableness of reporting. Quite frankly, the finance team is very responsive to our requests. And when we have questions, and we probably have sometimes more questions than seem reasonable to Allison, maybe, she's very quick to respond and very clear in her response. So I would agree with your assessment.
Okay. I've been on other quasi boards where there has been a practice to meet privately with the auditors, but I feel, given how clean this is, that's totally not necessary. But if any other board members feel differently, let me know. Okay.
And before we go to the next item, Sarah, I just want to let committee know that Ron is also going to provide a summary to the full board.
Good.
It'll be a little quicker than what I just went through with you here, but yes.
Very good. Next item is financial reports. Allison Murphy.
Good morning. Before you are the March financial reports. On the revenue side, mortgage loan and investment interest revenue are coming in 3.7 million below budget for the first 3 months of the year, and 4.7 million lower than prior year. The year-over-year revenue variances continue to be mainly driven by a net reduction in the authority's program assets, which are made up of whole loans and mortgage-backed securities, in addition to the higher rates of mortgage prepayments. The prepayments are still quite high. The first 3 months of this year compared to last year, prepayments are about $80 million higher. On the expense side, bond interest expense is below budget by 6.5 million for the first 3 months of the year, and 5 million lower than prior year, with slower than normal reservations. As Hazim had mentioned, the authority has issued more refunding bonds and long bonds, which has lowered our interest rates and costs. In addition, in March, the authority made about $162 million in special and optional bond redemptions. Most of those had premiums associated with them. So when they were redeemed, we had to accelerate the amortization on those, which accounted for about 3.5 million of the variance. Administrative expenses are 1.7 million under budget and 676,000 higher than prior year. When you exclude salaries and benefits, or 6.2 million, the current year-to-date expenses are 492,000 higher than prior year's expenses. And lastly, the change in net position is above target by 6.2 million. Are there any questions?
There's no questions. We'll go on to the delinquency and forbearance reports. Azim.
Good morning again. So for the month of March, we purchased 77 loans totaling 14.5 million. 96% of those loans were made into MBS, and then the remaining 3 remain as whole loans. The average loan size was about 188,000. The portfolio as a whole did decrease to 2.3 million. And in terms of the whole loan, the portfolio declined by 115, and the delinquency currently stands at around 3.18%. For the down payment, the funding ratio was 82% for the month of March. Regarding the forbearance, we did see a decline by about 95 loans to 532 loans, totaling 63.7 million of the unpaid principal balance. The average loan within the portfolio is 119,776 loans. Of those borrowers that are in forbearance, 18% of it are still making payments. For the multifamily delinquency, we did close 3 loans last month. 2 loans was for Armstrong Court 2 located in Greenwich, and 1 loan for Mapleview Towers. Delinquency stands at about 2.97%. For the multifamily forbearance, based on the program established last April 2020, we still have 2 projects in forbearance. The monthly forbearance for those 2 projects is $6,777. We provided a 6-month forbearance, so the amount of being forborne is $40,662. I'll be happy to answer any question regarding the delinquency and forbearance.
Hey, Sarah, it's Tim Hodges. Hazim, I do not have any questions for you, and it doesn't sound like anyone else does. I'm sorry, I'm driving. I couldn't get off mute quick enough. Allison, I want to make sure I heard you correctly. It sounds like the revenues are down, but expenses are up, and I think you either said 6 or 400. Can you tell me what's driving that?
I think the big difference with the expenses on administrative expenses is the foreclosure expenses are higher this first 3 months of this year than they were last year. That's pretty much the main driver.
And I'm sorry, and was the number 400,000? Is that what I heard?
Yeah, it's 492,000.
And that's the first 3 months.
It's the first 3 months, and a lot of those, we review our portfolio quarterly, and a lot of that was just cleaning up some balances that need to be written off.
Okay, that's helpful. Thank you.
Yep.
This is George. I have a question that came out as a result of the questions that was just asked. Can you talk a little bit more about the foreclosure expenses and balances you had to clean up? Because, I mean, this hasn't been a lot of foreclosure activity because the courts have been closed.
It's really more, not so much writing off loan balances as it is the expenses associated with some of the loans. FHA pays the majority of, they pay principal, they pay interest, but they don't pay 100% of the expenses while we're holding the loans. So we have to write off that difference, and we do so on a quarterly basis.
Yeah, but this is why your information is creating a question in my head. Mm-hmm. If foreclosures have not increased substantially because the courts have been closed and the forbearance, right? And they're close to what they were last year, why would the number be so much higher?
So
Well, part
Commissioner,
of it's-
can I add, like, to just add some color to it?
No, whoever wants to answer.
Yeah, so we are continuing to review the foreclosure, and FHA does allow us to complete a disposition so long as there is a certification that the property is vacant. So since that time, yes, the first 3 months of last year, everything got suspended, but the first 3 months of this year, we have closed out some files when we were able to do so once the servicer verified that the property was vacant. And during that closeout, that's the expenses that Allison was referring to.
So if I'm going to repeat what I think I heard, right? So those increased expenses are related to properties that basically been abandoned by that entity or person that was occupying the owner before.
Yes.
Okay. Has there been how much of an increase that has happened? Do we know?
It's in terms
And
of
if you don't have that,
count.
you can get it for later. I don't want to hold up.
Yeah. Yeah, we can provide you with the information. Yeah, but in terms of the count is very small, because the whole process is because there has to be an inspection, there has to be a verification. There's a lot of paperwork before we can even proceed.
Because the reason I ask is I get complaints from like the fair housing and other advocates saying that even though there is a freeze or a moratorium, that foreclosures is still happening, right? So it's good for me to know the details. So I can say, look, we always say that from the beginning that if a property was orphaned, meaning was abandoned, that was going to go forward.
Correct. You know? We are very
because the cities want us to go for it to go forward. The neighbors next door want us to go forward, right? And there is no harm being done because that the person who had the mortgage walked away.
Understood. We are totally in sync with the fair housing. Every single time when they see something, they will alert us and they say, hey, we saw this filing, it had CHFA's name on it. And when we verified, the property was in fact vacant, and we informed them, and they were very appreciative.
Well, if you could give me that, if you could share some of that information, I appreciate it, because we get the calls from them and the governor's office and other places saying, you know, do you know why?
Yeah, we can give you our example. I mean, we can't attest to.
Of course, your example.
Yeah.
Trust me, yes. Bank of America gives me their sample of Chase and so on and so on, right?
Right. No. Yeah, we are very strict with our services, and every single time when we see a filing, we tell them, please provide us with the paperwork.
Not questioning that.
Okay.
The thing is that everybody's under the perception that there's no foreclosures going on, right? And the numbers here indicate that there's some. So I was just trying to understand the reason.
Yes.
Okay, thank you.
Any other questions, anyone?
Sarah, I have just a comment. Hazim, last, I don't know if this is a proper juncture. I think we're doing pretty good on time, but Hazim, last board meeting, you talked extensively about the challenges of and our response for our challenges in single family production. Are you going to provide any follow-up to that at today or the board meeting?
I can. What I can say is after my presentation on April 8th, we rolled out the 0-point program for homeowners or home buyers, I should say, to elect either to pay the 1 point or the 0 point. And on April 19, we inform our originators, lenders, that they will be able to earn an additional lender compensation if they deliver the loans to us within 75 days of reservation date. And then tomorrow, we are rolling out a rate special for our down payment assistance loan, and to entice home buyers and to help them secure their homes. So since those roll out, you know, I can see, of course, I'll try to do a more formal presentation. But for example, since the rollout of the 0 point, we did see about 47% of new reservations since that date selected the 0 point.
Wow.
We have not seen, the landed compensation is still trickling in, and then we don't know yet about the 1%. But going back to reservations since January of this year, we did see an uptick in home buyers electing to get down payment. And we also saw an increase in the amount of down payment. So if you look at the report, we are currently purchasing on average between $5,000 and $6,000 of down payment loans. Reservations currently are coming in between 12,000 and 14,000 on average. So it has doubled. So we hope all these changes, and again, it will take time. And what we're trying to do is just trying to increase the purchasing power for prospective home buyers. But the thing that we cannot solve is inventory and that speed. Like if you have somebody who can bring in all cash or without any mortgage contingency, that's something that I'm not sure we have the means to solve. But what we can do now is we're trying to encourage and promote the program to say that if there are home buyers out there that would like to get assistance to buy their first homes, CHFA is here to help.
I wanted to comment
Great,
on
thanks.
the cash offers that we keep hearing about. And I have a friend who's a real estate agent, and she told me what people are doing, people that have retirement accounts, if they simply provide a statement of the retirement account as proof of funds, make a cash offer, and then they finance anyway. So the whole system is favoring people with assets, and they may end up not actually funding it with cash, but it gives them the power to say they could. Anyway, I just thought that was kind of an interesting wrinkle. It makes it very hard for young people who don't have assets to even play that game. So
Right.
Okay, any other questions? Investment and swap reports.
Okay, so the next item is our quarterly report to the committee. We just want to note that when it comes to our investment, book value increased by about 176 million to 3.55 billion from the last quarter. This increase primarily is due to the collection of principal and interest payments prior to the bond interest payment. So when it comes to the yield on such investment, it did go down from 2.07% to 1.91%. Again, this primarily is driven by the interest rate that's out there. When it comes to the swap, we did not enter into any new swaps since December 31st of last year. So the amount remains the same, and the pay rate also remains the same. However, the mark-to-market did increase because since December of last year, there is an increase in interest rate. Therefore, the mark-to-market value increased to 123 million negative. I'll be happy to answer any question. Sarah, I know that a few months ago you did ask about LIBOR. So we do have Bob Lam here to answer any question that you may have about LIBOR. We just want to note that since our report that we provided to committee last year, the regulators did extend LIBOR, and now the sunset date is June 30th of 2023 for certain indices such as the 1-month LIBOR and the 3-month LIBOR, which is the one that we normally use. We also have adhered to the ISDA protocol beginning of January. So what that means is if we have a LIBOR contract and the LIBOR contract is outstanding after June 30th of 2023, it would revert to the new index as determined by ISDA, or is in the protocol, I should say. So Bob, did you want to just add?
Yeah, I just said that. So as Azim said, you know, it was all moved basically to June 30, July 1 of 2023. There are two exceptions to that. If anybody had investments or agreements that involve 2-week LIBOR or 6-month LIBOR, those are still going to be toast at the end of this year. So they're going away. And what has happened is that the industry has determined and ISDA has put out that there's going to be adjustments between LIBOR and SOFR, because SOFR is an overnight secured rate and LIBOR was an unsecured rate, usually monthly or 3-month. The adjustments are going to be on 100% of LIBOR, about 11.4 basis points for 1 month and 26 basis points, 26.1 for 3-month. Because we do percentage of LIBOR swaps, for us at 2/3 or 67% of LIBOR, that would translate on the 1 month to about a 7.5 basis point adjustment and a 17 basis point adjustment in connection with any 3-month swaps that we have. But we do have some LIBOR, which is 100% LIBOR, it's taxable. And so, you know, we have to work with all of those figures.
So it sounds like you're saying the swap agreements are including new language that says you will adopt the protocol, the industry protocol. So does that mean you're amending all your swap agreements to include that new provision, or?
Well, so we always have the option to do something else at market. But if we want to do it where we are doing it at mid-market and therefore not having to pay any dealer fees, then we would adopt the protocol and the adjustments that are being made. And so as we get closer to when this happens, you know, we'll have to make those decisions on a swap by swap basis.
So if you decide the protocol works for you, you'll amend the agreements before.
Right. We'll just go along with what is going to happen to all of the agreements if you do nothing. So for us, it's kind of like having a free option. You know, we can adjust to SOFR or we can decide not to. And if we decide not to, we'll have to just pay an adjustment fee, a dealer fee to do that.
Because the documents provide the default for the mid adjustment is what's in the documents, which is what SIFMA is going to do, what the dealers are going to do. And you're saying that we still have the option to reject that. It just incurs the economic cost of being on the other side of the mid for that, right? Because it's going to mismatch because it's going to mismatch their hedges, right?
Yep.
Yeah. So I understand.
Can at some point we get an idea what the dollar amount may be? I know you give us some percentage, but the percentage don't mean nothing to me, because that means I have to do some calculation myself.
Yeah.
So the interesting thing is that it's not going to be a dollar. It's not going to be an adjustment to the fixed leg. It's going to be an adjustment to the floating leg. At least the way that I read all of the documents that are coming out, everybody is saying we need to make the adjustment to the floating leg to have full transparency.
So in English, that means the bottom line will not affect our financial?
It's not going to affect our fixed pay, but it will affect our floating receipt.
Okay, so let me reword it, since I cannot get a straight answer. I'm like a lawyer today. If I was going to make $1 million and I adopt any of these changes, whatever you want to call it, fixed, floating, magical, whatever, is my $100 million, my $1 million profit is going to change.
So it may change. I mean, the problem is what the ARC, which is the industry group that is working with ISDA on all of this, what they've done is that they've tried to find a mechanism which would get us to about the same as we had before with those adjustments.
It sounds like
And
the adjustments are to try to equalize the rates in the transition so that
between LIBOR and SOFR, right? Yes.
there is no winner or loser, but oftentimes the issuer ends up being the loser on some of these deals. But are issuers represented on this panel that's doing this adjustment? No.
I don't know, actually. I don't think so. I think it's mostly the industry.
Well, I mean, the whole LIBOR thing is partly going away because of LIBOR bid rigging and
Yes,
so,
indeed.
I
That's the reason.
don't know if we can trust them again, but anyway.
Well, at least in this case, we will have demonstrated trades. And that's the benefit of this versus LIBOR, is that you will have demonstrated trades and they will be published every day. So,
But Bob, back to the commissioner's question, is it that the industry is going to adopt a floating rate leg that should basically emulate or be the same as the floating rate leg on the underlying securities, and so that if we deviate from that industry position, potentially we'll introduce basis risk between the hedges and the underlying debt?
so it's not quite that, Jerry, because we always had some basis risk when we were in 1 month LIBOR or 3 month LIBOR versus our floating rate weekly that we have now. If we wanted to have no basis risk and we're willing to pay for it, we could switch to SIFMA. And we
Right.
could do that, anytime before, June 30 of 2023 and not have to switch into the SOFR routine.
But that would make our fixed rate leg presumably significantly higher.
Yes. I mean, like I said, we'd have to pay for it and it would probably be anywhere from 25 to 50 basis points higher on the fixed leg.
Look, I don't know if you, and I'm not saying this is the same thing, so nobody get excited, okay? But what happened in March with and I cannot pronounce the name of the company, Archegos, ARCHEGOS, and one entity alone is taking $5.5 billion loss, another one's taking $911 million, and so on and so on. And I'm not saying this is the same thing, but this swaps and this kind of things have a tendency to get out of control sometimes. So I really would like this, and I know we don't know which way we're going to go yet because final decisions haven't been made. But as we get closer to that, I really would like to get a better feel.
Yeah.
If we're going to take any kind of hit. And I realize that if that happens, it's nobody's fault per se, right? They changed the rules in the ninth inning. But I still would like to know that because I would like to evaluate the options we have, whether we spread it, whether, if we have the opportunity between years and so on.
So one of the benefits that we have, Commissioner, is that we don't enter into swaps to make a bet on interest rates. That's not how we do it. We do it basically because we're hedging variable rate risk. And so we're very disciplined about how we approach it, but we do understand your point that, sometimes swaps have blown up on people. And so part of the thing that part of the reason that we have been examining how we should proceed for now, a little over a year and a half now, Hazim, maybe something like that, is that we are trying to figure out where are we safest relative to going forward with respect to what we know about how the markets will operate. Should we be in Fed funds? Should we be in SIFMA? Should we be in SOFR with the spread? I mean, those are the kinds of choices that we have.
And just to add to that, and if you take a look at which RBC is going to present and provide a pricing update for the 2021B, the 2021B deal and the 2021A deal, we did not issue any variable rate bonds. Hence, we did not need the use of swap. So this is all part of the strategy that if and when we need to use variable, we would, but we will use it judiciously. And if and when we do issue variable rate bonds, we also want to make sure that we are hedged against any interest rate risk, of which we then enter into a swap. And when we do enter into a swap, we go through the whole process of, how much swap we want to put in, how long we want to be, whether or not we want to use SIFMA, what would be our optional termination rights, so that we don't lock ourselves in and get into a situation like what the commissioner mentioned, like things blow up.
Right, and the other thing that we do is we take a look at what is our exposure to the various counterparties. Because even though they have exposure to us now from a credit point of view, that could change. And so we want to make sure that we have a well-diversified counterparty portfolio of high-grade counterparties.
Right. So this goes
And
back.
all that, and who would argue that IGA was not AAA rated, right? And some of the other companies that fell in the past. And I'm not saying that's the situation here, but
Right.
it is my job every day to worry about safety and soundness and
Yep.
and those things, right? So, and when you say that we may have to pay, I forget the exact words you use, some sort of fee, that brings up my antennas and say, okay, what might be my potential exposure? And that's what I'm trying to get at, right? I'm not saying that we don't do due diligence. I'm not saying that you guys are not wonderful, great, but bad things happen to good people, right? And bad things happen sometimes no matter how good you are, right? Because that's the nature of life. Because if we knew how the markets was going to behave, none of us would be in this meeting. We'll all be very rich and playing the market, right?
One thing that crosses my mind is if you decide to convert these to SIFMA before the date of change, and that requires a resetting of the fixed and the variable rate leg, would that create like a tax event? Would that be considered a new issuance or a reissuance and maybe cause you to have to recognize the mark-to-market loss? Or I'm just wondering if there's any accounting or tax issues that might go along with restructuring the swaps.
See, and that was my point. After everything's said and done, what's the impact? For whatever reason.
Yeah, I'm thinking more of a financial or accounting or tax impact, but
Right.
As opposed to necessarily dollars. But anyway, something to.
When we have done it in the past, the lawyers have not brought up that there's a tax issue because it's all built into the new swap rate, all of the adjustments. But I can't tell you what lawyers will say to a year and a half from now.
Right.
It would seem that if the fixed rate leg moves enough, you could potentially trigger a reissuance, right? If it's over 50 basis points.
Yeah, the general rule of thumb is, and I think the guidance that the service came out, if we try to switch something, if it's neutral, that's fine. But if somehow it provides a big enough adjustment, then it may, and we use the word may because it all depends to the situation and then the analysis.
And one of the things that is sort of at the reason why this could be a little different than in the past is because the service has at least given tax councils some indication that they're going to be more flexible about how they see these adjustments as to whether or not there's a new issue requirement or not. Because I raised that issue probably a year and a quarter ago with both the ARC people as well as with tax council. And the information that came back to me was the ARC people were in discussions with Treasury and the tax people had reached out to the IRS and it gotten kind of an indication that they thought the IRS was going to be much more flexible than in the past. So that's why I say I can't tell you exactly what people are going to say, 15 months from now. So,
Bob, you bring up another good point, which is you don't know what the IRS, and for that matter, Treasury, which IRS reports under, and the leadership has changed, right? The whole philosophy has, to some extent, has changed. So that would be interesting, based on the people that have been appointed, you know, and to get a feel which way we think they may go, right? And I'm not asking you to give me that answer today, you know, because you know what we would have thought a year ago, right, is a little different than today because a year ago was under a Republican administration, and the treasurer has a much more different philosophy than the current treasurer, you know.
Right.
I think bottom line is we will continue to update the committee as we get more information.
And that's great. And I think this conversation was helpful.
I mean, this is a far cry now about what we know compared to what we knew a year ago. Because a year ago, the market was not ready to do this, clearly. And now it's becoming more and more ready. But it's not 100% there yet either. I mean, this is all something that's driven by a requirement to fix a problem that existed in fixing LIBOR. So it isn't like the market had already migrated there and we're just catching up the migrate because it hadn't. So this is something where we are basically taking a 5-year, what should take 5 to 10 years, and trying to shove it into 3 in terms of how to make this move. So there's a lot of stuff that has been, questioned in our mind and questions that we've discussed, heavily, and we're reaching out. I want to say I probably have a conversation about this every other week, in connection with what's going on and how is it changing and that kind of stuff. So we're trying to stay on top of it as much as we can.
Okay, I've always thought, why don't they just restructure LIBOR, fix what's wrong with it, but keep it as an index with the name LIBOR, and that would just make everybody's lives more easy. But I know it's not that easy. But any other questions on swaps or investments?
I just had a question on this, on the LIBOR issue. Does the interest rate environment have any impact on how easy or difficult it will be? So the fact that interest rates are at these historic lows, does that make it better or worse, or really no impact to do, to change over now versus in a more competitive interest rate market?
Yeah, so there is a little bit of an effect that does have, in that, if you recall, I talked about the change in basis points with 1 month and 3 month, and those were built off of curves that existed that they basically tried to do a look back over 5 years. If they'd done a look back over 10 years, those rates would have been different. So just because rates have continued to come down, if rates go up again, those, there could be potentially an adjustment to that. We don't think so right now because they've indicated that this is going to be their firm, adjustment. But if we had been in a short-term interest rate environment where the minimum that we were paying was 2.5%, for example, then these rates would have been higher. I mean, the adjustments would have been a little bit higher. So a small impact also on the floating rate side.
Okay, any other questions? We'll move to our last item, which is approval of the minutes of our last meeting on March 25th. May I have a motion?
I'll move.
Second,
Second.
roll call.
Amy?
I just unmuted myself. I'll start from the top. Jerry Abraham.
Aye.
Tim Hodges.
Aye.
Kathy McKinnon.
Aye.
George Perez.
Dang, since I was not here.
Okay. Noted. Sarah Sanders.
Aye.
Gwendolyn Thames. Okay, and Franklin is not here. Okay.
good. So now I'll offer a motion to adjourn our meeting. All in
So
favor?
move.
Aye.
George?
Thank you. I don't think we do a roll call on our adjournment vote.
No.
No.
Thank you, everybody. We'll see you on the other side.
Okay, thank
Thank you.
you.
Thank you.
Okay,
Bye.
bye-bye.